First and foremost, I hope you had a great Christmas and are looking forward to a great new year. We have had the pandemic, the inflation, the job market, everything is playing into the stock market, right? For us that are invested through brokerage and or retirement accounts, we are probably seeing more simultaneous red days with our portfolio than we ever thought we could have imagined due to the recent bull trend of the market. Now, let me be the first to tell you, this isn't a terrible thing unless you obviously make it one, right? In this episode, I want to cover some of the things you can do while others may be, pressing the panic button and selling off their investments. There is a light at the end of the tunnel, and for those that follow these simple principles, will catch up to that light and it will pay you dividends. Let's jump in.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Wow. First and foremost, welcome. I hope that everyone had a great Christmas and are looking forward to kicking off this new year in a great way. I know that I surely have enjoyed the time off, spending with the family, of course, obviously eating lots of good food, traveling back to Alabama, and then getting away from Hawaii for a little while. It's absolutely been great. I hope that you have as well have got a chance to visit with your family, eat that same great food, and if you got away from home for a little while, cool. If not, maybe that's where you wanted to be. Who knows? But there's a lot to be happy about as so much good continues to happen in my life, but obviously I'm sure it's also happening in your life. So I'd like to just take a moment just to think back and realize this is the last episode of 2021, and I want to thank everyone for tuning in this whole last year. It's absolutely been great. Lots of growth has happened in the past year with the Financial Mirror, and I look forward to 2022 and all the things that will happen in that year. I do think that this time of year, there's always so much going on from, prepping for the holiday shopping or, the family gatherings or the food, the cooking, the traveling, whatever. There's so much going on. We can always sort of lose sight of all the good things that are going on in our own personal life. So take a moment and really reflect on that and realize that I'm sure you have a ton of great things that have happened for you this year, the same as has happened for me. So as we wrap up 2021, I've had conversations, right, with some, and I've seen on the news, headlines are popping up all over, about the stock market, the crash, the bearishness, whatever. I'm sure you've seen it too. So it led me to want to do an episode to talk about investments. So I alluded to it last week in last week's episode, but I want to talk about your investments. That's right. This episode is all about you and the investments that you currently own or going to own if you decide just to start investing now. But no matter what article you look at, if you Google stock market, you are surely to find something that talks about crashes. Right here, stock market crash. Expert warns of massive drop as Fed pulls support. 3 things that you shouldn't do if the stock market crash. Don't wait for a market crash. These 2 top stocks are on sale. Sell everything now. The entire stock market's about to collapse. Mother of all crashes. You see the headlines are everywhere, right? Like these things are everywhere. So that's probably, got you a little like, oh my goodness, I don't want to get left in the dust. I should probably sell all of my investments. I should start selling my stock. I should start closing my mutual funds. I should start closing my brokerage accounts. I should get all in cash, put it in a savings account. Wait a second. Hold on. I understand where you're coming from. I mean, if I saw red numbers popping up all over the screen, it can make you feel devastated. I got it. But you there is light. There is light in the tunnel. If you listen to the the introduction. You know that we're going to get you to that light, but don't let your, feeling kind of devastated about all your hard-earned money sort of losing its value. Don't let that kill you. Not yet. Okay. So we have just come off a couple weeks of downtrending on the S&P 500. This can make you worry, but don't let it. Okay. Now, I'm going to start off by saying this because I will be talking all about investment information this episode, but I am not a financial advisor, nor am I a certified financial analyst. Everything that I talk about on this episode should not be taken as a replacement for advice from an accountant or personal advisor. The contents of the episode is for total informational and entertainment purposes only, and it does not constitute any financial, accounting, or legal advice. I'm saying that please don't go out and throw all of your money into an investment, take out a second mortgage on your home and put that into an investment. Please just take this for educational purposes, and understand that this whole idea is about this bearishness of a market and how you can overcome it. Okay. So I got the disclaimer out of the way, and I want you to know there's a ton of information about to come at you. There's a ton of information that's already out there. As social media and phone notifications are continuing to expand in their ability to identify things that you may be interested in, to keep you in the know, quote unquote, of everything that's going on, it can induce panic. And if you see that and you see others are in a panic, you can surely start to feel like you don't really know what to do either, given the situation could be kind of new to you, or just something that, you don't handle losing money very well, right? But this is where I hope this episode can clear some things up and can really help you in your situation. So without further ado, I do want to go over these things that can help you from obviously running into some of that same panic feeling that others are feeling during this time. So the first and foremost, I can tell you is do not panic. Okay. Don't panic. So I want to start, this off with that simple mindset. You've got to develop it. If you're going to look at your retirement or investment accounts, you've got to understand that you cannot panic. So don't panic. That's right. Don't panic. You had to know we were going to discuss this whole thing. And you knew I was going to tell you not to panic because it's in the title of the episode, right? But it's true. You've got to know now, right? Right now. Don't panic. Don't panic when you look at it. Don't panic. I can't say it enough. So there's a simple thing you can do to limit the amount of panic that you'll go through. It's actually very simple. But the first thing you can do is just not look at your accounts, right? If you're in the category, and I'm going to break this out into two categories. First off, if you're in the category where you are putting money into retirement and or an investment account, and you're not really nearing a retirement age, that is, you still have 10 plus years till you retire, this is totally an option and you should totally consider it. Okay. What this does is, the idea of you not looking at the account, it allows you to not really ever begin to worry because the account is going to be rising and falling, but it's all behind your back. You have no idea it's happening, right? So it'll make, that everyday work through of all that's going on in the market is sort of just going on behind you. And when the market is really healthy, if you see that there's just everyone's talking about all these great things that are happening, go look at your account. It may be motivating. But in times like now, where obviously every single piece of news out there is about a stock market crash and there's so much going on around the market, maybe not the best time to go look at that account if it's going to put you into a panic. So that's the first set of people. If you're not in this category and you are getting close to your retirement age, this is where a financial advisor should, actually be considered, right? They'll be able to give you some of the information that you need to get your money, that retirement money, into maybe a less volatile fund. So you don't lose as much of your nest egg in the coming months or few years, right? So that'll help limit that impact of the market shifting, because all in all, let's be honest, if the market does, have a downturn, it could take months to bounce back, right? It could take a couple years to get your account back to where it is right now. So with that being said, if this is something that is going to take possibly months to years to get you back to where you need to be, this is where, like I said, a financial advisor, financial analyst may be worth investing a little bit of your money into, to getting some advice on that, of where to put that money to make it into a less volatile fund. Because you don't really want to retire a year from now and your account still hasn't bounced back, right? So putting what you've got right now into a less volatile fund might be a great option for you. But all in all, if you're at that retirement age, you should already be looking at, how can I move my investments? How can I move my retirement account funds around so that I'm not losing all this nest egg that I've worked so hard to build? But obviously, this is only for that was only for the retirees. If you're not near retirement age, just don't look at it. And all of this is to say, listening to others and beginning to panic is not going to make any matter in your finances or in your investments any better. Okay. So if it'll only make you worry that much more if you look at it. So stick to knowing that if I don't look at it, I don't really have to go into a panic. But more importantly, if you do want to look at it, that's fine. But just understand that a normal part of investing is there's going to be ups and downs in a market, and you've got to be prepared, depending on your situation, for what's in that account. So if you are an upcoming retiree, you've got to know how much is in that account, how much you have to retire on. If you're not, you should know, do I need to increase or decrease my investments to get me to how much I need for retirement? But just don't panic. The biggest thing is just don't panic. Either way, you should have your finances under control enough that you shouldn't be panicking no matter what the markets are about to do. The next thing is, do not stop investing. You've got to continue investing. This is probably the toughest for me, but it's the most solid piece of advice that I can literally give you so that you can grow your money faster than you ever thought was possible. Okay. In the world of investing, we like to call it dollar cost averaging, DCA, whatever you'll hear it called. But simply put, this is where you are going to continue to invest so that your investment cost basis, or the average price that you've bought in to the market of that particular fund or equity, it's what that cost basis is, that average price, but it allows you to adjust that cost basis depending on the market, right? You get sometimes you buy high, sometimes you buy low, but in the end, you're going to take advantage of all the prices in the market. And that's why continuing to invest is so crucial here. If you're watching this live, or you're looking at this on the screen or as a video, you can take a look at the screen. If you're listening to a podcast, I am going to walk through this, but pretty much what this chart is comparing is the lump sum investment of $8,000 or a monthly investment of $1,000 over an 8-month period. So either way, the investment is $8,000. One, they put it in all up front. One, they put it in $1,000 at a time. Either way, it's $8,000 at the end of 8 months, right? So what you can see is the average unit cost for the lump sum was at the current market rate, which was $10 per unit. Okay, that was what the lump sum was. When you do dollar cost averaging, they're doing it at the current market rate over an 8-month period. So the first month they get at $1,000 at $10. The next month they get $1,000 at $14. The next month they get $1,000 at $9. The next month they get $1,000 at $13.5. Then 8, then 8.5, then 7.5, then back to 10. You can see from this chart that both the lump sum and the monthly invested $8,000. The difference was the return on the lump sum was 0% in this exact example, and the dollar cost averaging ended up actually returning 4% on the $8,000. So that's sort of the power of dollar cost averaging, and that's what you're going to benefit off of if you will continue to invest no matter what this market's about to do. If the market's going to crash, cool, buy. Continue to invest into your mutual fund. Let the market handle the calls. You just be consistent. I'm not saying throw all your money into an investment, right? What I'm saying is just be consistent. So if you were already putting $100 a month, continue to put $100 a month. If you were already putting $10 a month, continue to put $10 a month. Just continue to be consistent. When people are seeing their accounts dwindle, I know it can make it difficult to continue to invest into this. Like you're investing it, and then the next day, what you just put in there is now gone. That's okay. Be consistent. I'm telling you. Thinking back to what I just discussed, I want to allude to the fact that this is probably the most crucial time to continue to invest, because when it's high, you if you're buying in, you're buying those high prices. But right now, if it drops or when it drops or whatever, you get to take advantage of the lows, and that's what we need. When it begins to go back up, you have a lower average price, and you're now going to get all those gains. Okay, the main goal here is consistency, and in the end, you will win. You just got to continue to invest. I like that. That's like a little rhyme, right? In the end, you will win. You got to continue to invest. Hey, I like my little rhyme we just did. But anyways, when the market does correct itself and it does start to return back bullish, you want to have a lower cost basis or average price, because you will get paid out generously. I'm telling you right now, you will get paid out generously if you will continue to let those costs average out and continue to be consistently investing. So the last thing that I want you to keep in mind is you've got to focus on the long term. So I'm telling you, don't look at this as a short-term deal, because it's not. It is so important, and I mean so important to keep this in mind. The market is going to continue to go up and down throughout your lifetime. If you do start to panic sell, every single time the market takes a step back, you will never, ever reap the benefits of compounding, right? Plus, if you really want to know the honest truth, the only time that you officially lose money in the market is when you sell, right? When you lock in that sale, you've officially lost that money, right? So think about it. If you're at a casino, you're sitting at a poker table, you have all your chips on the table, you only have chips, right? Like they're not cash. If you keep betting, if you keep, playing, you may lose all your chips. They are not winnings or losses. They're just chips. The second you take those chips and cash them out and they are cash, you are done. Like that's it, right? Like that's what you've got. So it's a good way to look at it, because as long as you continue to invest in the market's going to continue to return you chips. Sometimes it's going to take your chips. Sometimes it's going to give you chips back. Sometimes it's going to give you more chips back than you ever thought was imaginable. But the part is you continue to stay in the game and you never took yourself out. So one thing I wanted to bring up here, and this is an example that you probably saw coming. Anytime we start talking about long term, we can talk about this. But back at the beginning of December, I did the Honolulu Marathon, right? So what I wanted to use is that as an example, because obviously we talk about marathons, not sprints, right? What I wanted to allude to is that what if I started that marathon, 26.2 miles, and I started running it at a 6.5 minute mile pace? Sure, I can go out and run a mile at 6.5 mile pace, no problem. Tell me I can do one of them, and I will go out there and I will smoke it at a 6.5 mile pace. But how about you tell me I've got to do that for 26.2 of them? Not happening. Definitely not going to happen, okay? So I will eventually slow down. If you told me I had to do that, I will eventually slow down and probably ultimately give up if I tried to maintain that pace the whole time. So we always have heard it. It's a marathon, not a sprint. But this is the same, and this is the exact same as what you will see with your investments. They're not it's not about panicking. It's not about, letting the market just start to dictate your feelings and how you feel about your investments and your retirement account and all that thing. It's not about that. It's all about continuing to ride those ups and downs, knowing that in the end we grow, right? The market continues to grow. It continues to chug along no matter what. Even through all the setbacks, it chugs along. In that marathon, I continued to chug along. I had setbacks, cramps, feet hurting, whatever. Feet hurting. I'm talking about, I wasn't tired. My feet were just killing me. I'm not lying. My feet were hurting, and that's another story. But no matter what, I succeeded at the end. I finished the marathon. You will succeed, and you will finish and get to your retirement goals as well. You just got to continue to put in the time, put in the money, put in the effort, and your account's going to look so much better when it's all over. And when you're thinking about long term, if you're looking at this on the screen, you can see this is over a long term, right? Like, we can go back to 1995 when I'm looking at the SPY right here, which is an ETF. It follows the S&P 500, right? We look back to the SPY was trading at $56 in 1995. Boomed all the way to about $156 in 2001, right? Pulls back, heads back up, peaks back out at about 156, falls back down, right? We hit that 2007, 2009 Great Recession, right? We get back into that. That first pullback was that dot-com bubble, right? It fell. Then we get the Great Recession, right? And then we pull back up. And we go on a run from 2009 pretty much all the way till a little pullback right there about 2018. And then it pulls back again in 2020 for COVID. All of that to say, if you remember, $56 the SPY was trading per share in 1995. Today, it is trading at $459. Let's just say $456 for easy math. $456, $400 growth, right, per share. If you were averaging and consistently investing for that whole 95 to 2021 timeframe, could you imagine? You didn't make $400. You made the whatever your cost basis is times whatever your shares are, right? So, or the difference in the two. So you have a huge return on your investment. You didn't pull out during the dot-com bubble bust. You didn't pull out during the Great Recession. You didn't pull out during COVID. You continue to invest. You continue to build that nest egg, and you can see the market will reward those that do that. And that's what I really want you to understand. If there's one thing I want you to understand is that. So no matter what happens throughout the market, if all these people that are talking about stocks crashing and sell everything, here's what you need to do, Kramer said this, stocks are going to plunge. If that happens, cool, don't worry about it. It's not that big of a deal. Yes, your account may fall in value. Yes, your dollars in your account may not be worth as much. Yes, I got it. But if you will consistently invest, if you will consistently put your money back into the market, if you will consistently make those investments, no matter what they are, if they're $100 a month, $50 a month, $10 a month, $5 a month, $1 a month, if you will continue to be consistent in your investing, you will 1,000% end up better in the long run. You 100% will. 100% will. And that's the part that I really want you to understand. I want you to understand that the market is about consistency. The market is efficient in a sense that it allows for itself to move and flow with the buyers and the sellers, right? It will consistently move and flow. And as you can see on this chart, it will continue to rise. The thing about it is there's going to be pullbacks. There's going to be all of these. I mean, and if you look at it, I mean, let's be honest. From pretty much when that end of March, February, March, when that huge sell-off happened for COVID, man, what a rebound. I mean, a rebound. This thing has not slowed down, but for about 2 months at the end of 2020, and then boomed all over again. I mean, this market is it has been as bullish as we can imagine since that original COVID pullback. So I'm telling you, if it does pull back, cool. That's okay. Just continue to invest. Continue to put your money into it. It will pay off in the end. Don't give up and start selling your investments because everyone else around you is panicking. Continue down the path toward long-term wealth generation. That's the key here. That's the key, and you will do it. I found this little stock market crash calculator on NerdWallet. I thought it was pretty interesting. It pretty much, you can type in a stock portfolio balance before a market drop. So I in here, let's just do like $10,000, right? So we type in $10,000, then you can pick which sell-off you wanted to replicate your account for. So let's do like the .com bubble. Your $10,000 portfolio would have dropped to $5,000 during the .com portfolio bubble, and if you would have held on to it, your $10,000 and not put any more money into it, your $10,000 would have become $21,000 as of December 31st, 2019. So roughly 19 years later. Or you can do like that 100,000 during the Great Recession. So 2007 to 2009 portfolio out of 100,000 would have dropped to 43,000 and rebounded 5 years later to it would have rebounded. You would have broke even back at about 5 years later, and then as of today, or as of December 31st, 2019, your account would have doubled to 206,000. So I mean, big difference. I mean, you can tell this market is efficient, and if you will continue to invest in it, it'll pay off for you. Okay. So all that's to say this: you can see in the long haul, your investments will pay off. So don't sit around. Don't be worried about what the market's doing. Don't be worried about what the news is saying. Don't be worried about what your friends are doing. Stick to knowing that the market's efficient, the market's consistent, and it's going to allow for your money to return what you put in plus some. So continue to invest, and you will be rewarded for your patience. Okay. Now, if you are ready to take control of finances and you want someone to sit down with you just to look at your investments with you and sort of be there with you to ensure that you are on the right track, a financial coach might be exactly what you need to get started and really get on that road to financial freedom. So if you need a financial coach, please go to thefinancialmirror.org/contact. Fill out this contact form. You'll just log in, hit the message, submit it to me, and then I'll get your email. You'll get a free consultation. We'll get you set up. You will be on your way to achieving your financial goals. Finally, if you do want to give a little extra dose of support to the stream, just go over to my Financial Mirror merch page where we have all kinds of great merchandise, from coffee mugs to t-shirts, mouse pads, bags, hats, jackets, whatever, to get you what you need in your Financial Mirror gear. I truly appreciate everyone for tuning in. Don't forget to subscribe, like, comment, share with the people in your life that can really use this information. If you are listening to this on a podcast, I first off want to thank you. Please don't forget to subscribe and leave a 5-star review if you're listening to this on Apple Podcasts, and a written comment. as both of those truly do go a long ways in getting this information out to more and more people. I hope that this investment guide, I guess you could say, for the upcoming market, it can really provide you some value. And if you do think it provides you value, share it with others that you think it could provide value to as well. So until next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.